In the wild world of trading, we're all just looking for something to give us an edge, right? A tool that can cut through all the noise and just show us a clear path. And one of the most popular tools for that is the Heikin Ashi chart. It promises this super clean, super clear view of the market. But what if that clarity comes with a hidden cost?
What if I told you that this clean, simple-looking chart might actually be hiding the most important information from you? That it's not really telling you the whole story? I mean, let's just ask the question outright. Is your trading chart lying to you?
And I get why traders love it. I mean, look at that. The trends are so smooth, you get these long, beautiful strings of colored candles. It really does filter out all that choppy market noise and makes spotting a trend look incredibly easy. It seems like the perfect solution for finding a trade and, just as importantly, staying in it.
But, and you knew there was a but coming, as our source material from babypips.com points out, there's a catch, and believe me, it is a big one. Heikin Ashi is useful for sure, but as we're about to see, it has some pretty serious limitations that could totally change how you read a trend.
So let's just rip the Band-Aid off. The first, and maybe the most shocking limitation, is that the price you see on a Heikin Ashi chart, well, it isn't actually the real market price.
Okay, let's look at this daily chart for the euro versus the US dollar. I want you to focus on that very last candle. It's red, right? So that's clearly telling us that the price closed lower than it opened. It was a down day for the euro. Simple enough.
But was it? Was that the reality of what happened in the market on that specific day? Let's take a closer look.
Okay, now we're looking at the exact same trading day, but with a standard, regular candlestick chart. And whoa, look at that. The last candle is green. In reality, the price actually closed higher than it opened. The EUR/USD pair actually ended the day up.
And this comparison right here just illustrates the problem perfectly. On the left, Heikin Ashi is basically screaming downtrend continues with that red candle. On the right, reality is showing a green candle, a potential reversal, or maybe just a pause. We are getting two completely different stories for the exact same day.
Breaking down the numbers makes this difference even more stark. The Heikin Ashi chart, it showed a close of 1.08531, which was a loss for the day. But the actual market close shown on the traditional chart was 1.08706, a gain. The numbers just flat out don't match. So why?
Well, this brings us to the secret behind Heikin Ashi. And it's not magic, it's just math. And that math fundamentally changes what you see on the screen.
Here it is. The formula for the Heikin Ashi close, it takes the open, high, low, and the actual close of the period, adds them all together, and then divides by 4. It's an average. It is not the true closing price of the asset.
And that's the key takeaway here. The single most important piece of data for so many traders, the actual closing price, is completely obscured. It's hidden. You simply do not see it on a standard Heikin Ashi chart.
So this averaging thing, it doesn't just hide the price, it also creates another problem. It actually makes the chart a little slow.
Because the Heikin Ashi formula uses information from both the current period and the previous one, it inherently creates a delay. We call it lag. A new trend or a reversal has to be much more established before it will finally show up on the chart, so it's always playing catch-up with reality.
So what does this lag actually mean for your trading? Well, it really depends on your style. If you're a swing trader or position trader, holding trades for days or weeks, this might not be a huge deal. But for day traders or scalpers who need to get in and out of trades fast, this delay can be an absolute deal breaker. The signal you're waiting for might show up way too late.
Okay, so if the price is wrong and the signal is late, should we just throw Heikin Ashi in the trash? Not exactly. We just need to completely change how we think about it.
And here is the big aha moment from Baby Pips. The smartest way to use this tool is to stop thinking of it as a price chart and start treating it like an indicator. Its job isn't to show you the exact price, its job is to show you the strength and the momentum of a trend.
So here's the new strategy. Use the Heikin Ashi chart to confirm if a trend is strong and smooth. But when it's time to actually analyze the price action for your entries and exits, you've got to switch back to a traditional candlestick chart. Use them together and you get the best of both worlds.
After everything we've looked at, what is the single most important thing to remember about Heikin Ashi?
It's this. Heikin Ashi is not a replacement for a standard price chart. It is a specialized tool, almost like a momentum gauge. It's brilliant for seeing the strength of a trend, but it's the wrong tool for seeing the actual price.
So, Heikin Ashi isn't the holy grail some people make it out to be. It doesn't show you the real price, but it does reveal a trend's true momentum. So, armed with this knowledge, the real question is, how will you use this powerful but misleading tool in your trading now? Thanks for joining us for this explainer.